This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
We've got a question here, Robertus and Ingrida. And he acquires the 75% of the issued capital of Ingrida that's in on the 1st of August. To working one, there's a slight variation to working one, which I'll show you when you've done working one. It's only a slight variation. It's nothing where you're going to get working one wrong. It's just an addition to the existing working one. In the situation of a mid-year acquisition, it really is essential, in order to time allocate profits and work out what are the net assets at date of acquisition, it's essential that we know the pre and the post-acquisition period. So how many months pre-acquisition and how many months of post-acquisition? I'm going to have to work it out for myself now, so you carry on without me. Well, thank you, two of you, for getting it wrong. 7 months pre-acquisition, 5 months post. January, February, March, April, May, June, July, 1st of August, 7 months pre. August, September, October, November, December, 5 months post. All right. Beware the year end not being 31st December. This one is 7 months pre and 5 months post. Okay, well now you can do working two. You can do working two. What was working two, Ginter? At the back, Ginter, working two is goodwill. Yeah, and who do we think of when we talk about goodwill? Oh, come on. Stand up when you're thinking about the Queen's daughter. That's the goodwill. Don't know if you're conscious of the fact, but we valued the company at 22,000. That's the cost of our investment and the value of the NCI. So the value of the company, according to acquisition details, is 22, but the fair value of its net assets is 28, so we've made a bargain purchase. So this is negative. How do we get to 28? this figure and this figure. In the question, share capital in the subsidiary, date of acquisition. That's a little lesson to be learned. Take a straight edge with you into the exam. Take a straight edge, a ruler, a 30 centimeter ruler. Take one with you into the exam. It doesn't particularly often apply in consolidations, but it will apply in question 2, where you've got words on the extreme left of the page, you've got figures on the extreme right of the page, and it's easy when you're reading across for your eyes just to drop down one line. So take a straight edge with you into the exam. It's just happened twice now in this room with this example. Imagine when you've got a question facing you which has got maybe 25 figures within it. It's very, very easy to pick up a figure wrong in the exam. These are question 2 examples. These questions 7, 6, 7, 8, 9, 10, 11, 12. These are question 2 examples. Just a whole load of figures. Over on the extreme left, the words, the title. Over on the extreme right, the figures. And it's very, very easy to pick the figure up wrong. So take a straight edge in with you. Right, so we've got negative goodwill in working 2. Working 3. What's working 3, Lena? Consolidated retained earnings. Working 3. The examiner, both this examiner and your P2 examiner, they actually work together. They work in the same place in Manchester. And so far as I'm aware, I think they used to share the same office. And it's not beyond the realms of possibility that they would speak to each other about what was in their various exams. And they both of them have said that they don't like the idea that students just learn by rote, just by remembering blah, 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 blah. They want you to show understanding. That's why I keep asking, are you all right? Do you understand? What's the basis of the calculation? What is it we're trying to find out? And I'm not sure they even like the structure of working 1, working 2, working 3, working 4. But if you look in the BPP text, and you look at some answers in the BPP text, you'll see the structure, working 1. You'll see a goodwill calculation, if I can find it. That was actually part of the answer itself. Calculate the goodwill. There's an adjustment for non-controlling interest, not an adjustment, a calculation. There's adjustment for a calculation for retained earnings. And you will find these. You will find these within the answer. There's another one. We've got a structure, goodwill calculation, retained earnings calculation, NCI calculation, working 1, 2, 3, 4. If you learn them in the way that I'm telling you, all right, it's rote learning, and we had a little game just immediately after lunch. What's working 1? What's working 1, Irina? Structure. What's working 2, Genta? Goodwill. Working 3, Vita. Working 4, Svetlana. Non-controlling interest. If you learn them like that, if you learn them so it becomes automatic, then when you're sitting in the exam room, you're not having to sit and think, what should I work out next? It's automatic. I've just done working 3, so now I do working 4, and it becomes an automatic sequence. You will dream about this when you go to bed in the evening. You will dream about working 1, working 2, working 3. And you will. It becomes routine. And to promise you, I expect you to tell me tomorrow, I expect you to tell me what you dreamed about tonight, what you dreamt about, working 3, H is on plus H is shared, post-tax retained, that's goodwill impaired since acquisition, just our share. Working 3, here we go on working 3, Robertus and Ingrida. Per the question, But the question, retained earnings for Robertus are 34,000. Are you happy with that figure? It's the combination, it's the year-end position. 34,000. For Ingrida, it's 26,000. Now, there is a shortcut with Ingrida. Remember, what we're trying to do with Ingrida is we're trying to find her post-acquisition retained. There is a shortcut. I would never take it. I wouldn't take the shortcut because there are possibly adjustments to make. So I would always go the long way round. If I take away the pre-acquisition, now I've actually worked out up here in working 2. Look at that. Your work is done for you. Look, in working 2, we know what the retained earnings were in Ingrida. There were 20,000 brought forward and 3,500 for this year. And that's always going to be the case. But when we're looking for the pre-acquisition profits and the subsidiary, we will already have calculated them in working 2. So there's no additional work to do. Your danger, listen, your danger is to say pre-acquisition profits 28,000. That's wrong. The pre-acquisition profits is those two. 23,500. So 23,500 is pre-ac. Therefore, post-ac is 2,500. Now, I did say there's a shortcut to arrive at that, isn't there? 2,500, you can see actually it's 5/12 times 6,000. A very quick and easy way. It's the post-acquisition period times 6,000. I wouldn't do it. I would not do that. I would set it out the way I have done on the screen. Our share of that, I forgot what percentage we had, 75%. 1875, 1875. So 35,875. From working 3, you remember the song for working 3? H's own plus H's share of S post-ac retained, less goodwill impaired since acquisition. Well, there is no goodwill impairment this time, it's negative. So there's no goodwill impaired since acquisition. But we do have to get rid of this goodwill. 6,000, wasn't it? 6,000 goodwill. Working 4 is the NCI, the 25%. The value at date of acquisition, 7,000. The share of post-ac retained is 25% of. We got the figure up here. This is post-ac retained, 2,500. We're not going to give them any share of the profit that we made on acquisition, the bargain purchase. They're not entitled to that. That's our good negotiating skills. I think you're ready to do the balance sheet. Well done those of you that have added the goodwill to the retained earnings. Well done. If I go back up to working 3, I put the goodwill figure in, and some of you have missed it off. I put the goodwill figure in, but I didn't adjust the calculation for it. I wanted to see if you could do it. It's a bargain purchase. It's a profit that we've made. We've spent 22, we've bought 28. We've made a profit. And once we've reassessed the fair values at date of acquisition, if we've still made a profit, if it's still negative goodwill, then we'll credit it at the first opportunity. So 41,875 is the retained earnings figure. And coming down here then, 41,875 should add up to 54. Yes, it does. But well done those of you that saw it. Well done. Is it beginning to make any sense? Yeah? Good. I want you to put your mind back till 9 o'clock this morning, or just after 9 for some of you. Just put your mind back to about 9:05 this morning and ask yourself, what did I know about consolidations at 9 o'clock this morning? And probably the answer is not a lot. And now think what you can do. You're all right in terms of the workings. These are the main workings. And this is where your marks are. This in an exam is where the marks are. The marks are in the workings. Look at the balance sheet, for heaven's sakes. That's in working 2, so we've already scored the marks for Inca. How many marks are there for adding 12 and 30? I know some of you are having problems adding 12 and 30. And you're not alone, Vita. You're not alone. There are others. How many marks for adding 13 plus 4? Not many. How many marks for getting share capital right? Always, only, ever the parent company. Share premium? Nothing to it. Literally, nothing to it. This is in the workings. This is in the workings. How many marks for 1 plus 3.5? There can't be many. There may be 1, half, something like that. But the marks are in the workings. And the better you are with your workings, and the more comfortable you are with the workings, and the ease with which you lay the workings out, and the clarity which you display when you're doing the workings, get them all neat and in line and easy. It makes the marker happy. And a happy marker is a generous marker. So make the marker happy. He is the most important man in your life. Between doing the exam and getting the results, you've got to keep him happy. They send all the female scripts, they send them to men. All the men's scripts, they send to women. You didn't surely believe that? No, I don't believe that either. No, they just send that your scripts will be scanned and sent around the world. Markers anywhere in the world, in Nepal, in Chad, in Antarctica. There are people waiting to receive your scripts in order that they can mark them. They are scanned. They're no longer hard copy marked. They are scanned into the computer and sent away to people with tablets like mine, and they will mark your exam on their tablet. Seriously. That's why it's important you set them out right. And when you look at the A4 booklet, there's a margin down the left-hand side, there's a margin down the right-hand side. You must not write in that margin. You must not extend your workings down there, because that won't be scanned. All right? Right, we're on to, we've just done Robertus and Ingrida, we're now on to fair values. How many times have I said today we're going to compare the value of the company with the fair value of the subsidiary net assets at date of acquisition. With the fair value. If I've got PPE, property, plant and equipment, of 80,000, and I've got other net assets of 30,000, a very, very, very simple statement of financial position. I've got shares of 40,000 and retained earnings of 70. There's your balance sheet. Net assets equals capital employed. But what if we look at these net assets as an acquiring company, and look at these net assets and say, well, that property, plant and equipment, that was actually property. And it's property in a very desirable area of the city. This is property in ACCA, down near Passagiero was this. Very desirable location within your city. That property at 80,000 actually is worth 100,000. But it's in at historic cost, less accumulated depreciation, and that's the book value, the carrying value. These shareholders' funds of 110 only represent the carrying value or the book value of the net assets of the subsidiary. And we've got to look at the fair value of the net assets of the subsidiary. So when I'm listing these shares and retained earnings at date of acquisition, what I really ought to be doing is saying, well, that's actually worth 20 more. So these reserves should be increased by 20. That's the fair value of the net assets. So now in working 2, we're going to have cost of investment, the value of NCI, and we're going to compare that with the fair value of the subsidiary net assets at date of acquisition. That's made up of shares. What did I say? 40. Shares 40. Retained earnings 70. Fair value adjustment 20. Fair valued net assets at date of acquisition are in fact 130. When it comes along to preparing the balance sheet, to preparing the statement of financial position, remember this is a subsidiary. The parent company's got 115,000 PPE. When it comes to preparing the consolidated, it's 115 plus 80 plus 20. Just a cross addition. Maybe the other net assets. Maybe that the inventory is also over or undervalued. Maybe liabilities are understated. Fair value adjustments will, in the exam, they will need to be made. You will need to make fair value adjustments. Past exam questions on consolidations. Starting with December 05. No, I'm not, because that's a different type. That's a small question. June 05. Highfield has a policy of revaluing land and buildings to fair value. Fair value adjustment needed. June 07. At the date of acquisition, the fair values of the subsidiary were approximately equal to their carrying value, with the exception of its properties. These had a fair value, 40 million in excess. December 08. At the date of acquisition, the fair values of the subsidiary assets were equal to their carrying amounts, with the exception of an item of plant which had a fair value 2 million in excess. June 03. The fair value of the subsidiary's assets were equal to their book values, with the exception of its plant which had a fair value of 3.2 in excess. June 06. At the date of acquisition, the fair values of the property of the subsidiary were 1.2 million in excess of their carrying values. December 09, the fair values of the net assets. Do I have to go on? It's every question. There is a fair value adjustment to make. Every question, every time, every exam. At the date of acquisition, the carrying values are equal to their, or the fair values were equal to their book values with the exception of, and that's the fair value adjustment, the exception of. At the date of acquisition, there was 5 years remaining. The fair values of the net assets were equal to their carrying amount with the exception of property and plant. Property had fair values of 4.1 more. At the date of acquisition, I don't have to keep doing it. Sure, the fair value of the plant was 20 million in excess of its carrying value. It's every single question. A fair value adjustment, and there it is. I've done the fair value adjustment. I've done it in working 2, and it also affects the balance sheet because you need to include the fair value adjustment in the cross addition. There it is in working 2. Shares, retained earnings, share premium, but the fair value adjustment.